This is a 5-minute video going over what happened with this particular trade. I had an expectation. That expectation was met absolutely perfectly, yet I didn't even trade it right. So basically what I was looking at is how the midpoint between this buy side pull and the next nearest major buy side pull, I'm expecting that to likely reject price, looking for reversion back to the mean kind of trade. That was my expectation. I really liked how we had these hourly openings prices and been held at a premium above them all the way up going into 7 a.m. And I was watching live as on the 1-minute chart as gold hits the exactly the point that I was looking for. And yeah, and sold off. I got in a small size just on this wick, but didn't get on the size I wanted. Also didn't have the conviction to put on the size I wanted, despite exactly what I wanted to see happening. Sold off. I closed out like straight away as well because of frustration out of not having the size on that I wanted. We then had this event. I shorted again up in this area. We sold off. I took basically the entire position off here. Once again, just because of uncertainty and think, oh, maybe it's just going to come up and swoop again. And then when I was in this area, I was tempted to short, but I thought, no, I'll try and get a little bit higher. So I put a sell limit just up here, and that didn't hit. And it resulted in a really large move. If I have an expectation and it's hit absolutely perfectly, I want to be able to trade it in a mechanical way. And the problem that I've been having that I think this kind of exemplifies is how I have an expectation on price, but I don't have a mechanical way of actually taking advantage of it. It should be, okay, I have my expectation, and now if this, then I do that. So at the moment, I currently don't have enough of a mechanical approach. Like, it's not a back testable approach. It's more like, okay, I think something like this will happen. Okay, let me try and find an entry technique somewhere in here. Just trying to think about how I can describe what I'm trying to think about and do. But essentially, I want to be able to have my expectation on price, and then after my expectation, I need to be able to have a back testable way of going about it. So, for example, let's say I know that I want to see rejection at that particular level. So this is even going to work. There we go. So I want to see rejection up at that level up there. And I have a very back testable way, which means that, okay, let's say one could be maybe the high time frame entry. So enter at level with a stop, halfway between that and the next liquidity pool. And then if that's, and that could be one scenario. And then other than that, you could also be looking for, after hitting that level, okay, I'm going to look for that level. Then as soon as we get a fair value gap, then I'm going to sell on that fair value gap at the market structure shift. And then that could be the next back testable model. Okay, does that give me, how many are, etc. The next one could be maybe just looking for that opening price on the hourly candle. So once we've displaced through that opening price in the hourly candle, okay, and after hitting that liquidity midpoint, so no matter where it is, like if we hit the liquidity mid, then I'm expecting us to reject from, and then we displace through an hourly open, then I look to sell the open and target 2R or something like that. That could be another potential model that I could backtest. So that's the key. The key is that I need to be able to backtest it, because like I can be perfect, like within like a couple of pipettes of the actual high. And if I don't have the conviction to trade it, then it doesn't matter. Like I could literally catch the high of day, which I did, and I don't have the conviction to trade it. Unless I have a back-tested model where I say, okay, if this, then that. And this is pretty easy to spot. Like the exact same scenario happened here. We've got the midpoint between this pool and this pool, drag that across, and then we hit it there as well. I can drag that up and have a look at it. But yeah, if you looked at like the hourly open, that would be down here basically. And yeah, it runs up to a premium. 1900 opens up. It soups, displaces low with a nice fair value gap from that liquidity midpoint, and then puts an intermediate term high that would be a nice short. So if I can work this out and make it really backtestable, that's the key. Is that I need to be able to backtest this up and actually be able to go back through data and say, okay, this is exactly what I would have done. Like the same thing, this particular scenario down here. So we have this sell side pull and this sell side pull, and then I can drag that across. Okay, and it doesn't always go exactly to the that price point. So I think this is actually reasonable. As you can see, it comes really close to it on the high time frame. It's like within, just a few percent of actually hitting it, and then it starts pushing up higher. And if I can have a standard operating procedure for this type of scenario, and that might be that where we get in just before it hits or at the new opening gap or something, and then put your stop below the midpoint of the next two pulls. And that's just a higher time frame move. So yeah, that's my thoughts on that. I just need to have it more back testable and know exactly that if I'm right on something, if I'm right on my expectation on price, I need to be able to execute on it and should be making money. If I'm correct on something, then I should at least make some money, even if I don't hold for the entire move, even if it's just like, okay, cool, we hit the midpoint, I'm selling this fair value gap, stop above the high, holding for 2R, and then done for the day. That could be fine as well. I don't need the whole move, so but I can catch the whole move.